Hey everyone. So today I want to share with you an exciting project or a deal that one of my buddies, Brandon, who is part of our acquisitions accelerator, is working on. By the way, yeah, if you don't know me, my name is Moran Pober. I'm founder and CEO of acquisitions.com and rollups.com. We've been involved at this point in more than $1 billion worth of transactions. So back to this deal, Brandon is about to close a deal on acquiring a company. And hi, Brandon, if you're watching this, I'm doing this video for you. And he wanted me to look into details of his deal. It's already signed. An LOI is in due diligence right now, and I thought it would be helpful to share some insights with all of you, uh, keeping the business name confidential, of course. And yeah, let's dive into basically today the due diligence documents when it comes to what you need to go through when you're buying a business to understand um, what makes a good deal or not. We'll go through it step by step, explaining everything in the, at least I try, the simplest terms possible, right? So business acquisitions due diligence, that's the plan. I'm also going to play around with this kind of a tool that looks interesting. And thank you for the team that helped me create this presentation. So let's get started with the byline. Let me remove myself around here, or I'll put myself here. So byline bank pre-approved term sheet. What that in the first place? This document is basically is a document that was received from one of the banks, and it's not a final commitment, but it's initial positive review based on the information given so far. It means that the byline bank thinks that the business deal looks promising, and that's why they made this offer and gave this term sheet. But Brandon still needs to complete the full process. It's kind of like a full application process to get the final approval for the loan, which is in the process right now. Right, so Byline, just a bank. That's just one of the offers Brandon received. I know he's talking to other banks as well to see who's going to give him the best deal. And the loan detail, so there's loan amount and type, right? So we have up to 5 million through an SBA 7A term note, right? And this is basically the type of loan, if you don't know, that is backed by the Small Business Administration, which is SBA. And it also basically a loan that helps small businesses get loans by guaranteeing a portion of the loan amount. Interest rates. So in our case, we got an offer prime rate plus 2.75, which currently in total that's 11.25. So this interest rate for the loan is based on the prime rate, which is the interest rate that basically banks out their charge their customers. Plus they put an additional 2.75. This means the total interest rate right now is overall 11.25, right? That's the prime rate plus 2.75. Maturity and amortization, the offer is 10 years. So maturity is basically the length of time that Brandon will have to pay the loan. And amortization, this basically means the loan is paid off over time with regular payments, and it's covering both the interest and the principal, and it's going to happen over 10 years. That's the idea. Let's move to the next part. And by the way, I just moved all the information from the term sheet into this. My team did to this document because, again, I didn't want to show anything confidential, but this is what's in the term sheet. Maybe we could drop in some screenshot of it, of just the confidential stuff, but this is from the actual term sheet. So let's go through business purchase. Business purchase, this is basically just the price to buy the business. Packaging fee, $2,500. It's a fee for processing the loan application. It's very common to take different fees. SBA guarantee fee, right? So it's a one-time fee charged by the government to guarantee the loan. Again, great way to make some more cash. Closing costs, those are costs associated with finalizing the loan and the purchase of the business. Then we also have total project costs. It's basically the total amount needed for the acquisition, right? So that's the total. And there's cash injection for a bit more than $1 million. It means that equity investor / Brandon needs to come up and contribute 10% of the total project cost from their own funds. And right now, we already introduced some equity investors to Brandon. We'll see. We might even look into invest in it ourselves based on how this document is going to go through. So this is me basically analyzing the deal live with you guys. And then seller note 40%. That's about 4 million. The seller agrees to finance 40% of the purchase price. This is like a loan from the seller to Brandon, which he will pay back over time using the business cash flow to pay for it. And in the end of the video, we'll go through some of the financials of the business to see if this is what we think a good deal or not. And I'd love to hear comments below as well on what you guys might think. Next, in the term sheet, we'll see collateral and guarantees. So collateral is basically assets that are pledged to secure the loan. And we have first position, UCC filing, it's legal claim on all business assets that are now owned by the business and in the future, right? So anything that basically the business got is going to be used as collateral. We have best position UCC filing on affiliate business assets. So if Brandon, let's say, has other businesses, so their assets can potentially also be used as collateral. We have collateral assignments of leases. So the bank can take over leases if Brandon defaults. Right? I'm going through, maybe might be boring for some of you, but this is just super important notes and details on deals. Then we have best lien on personal real estate. So that means that the bank will have claim on Brandon's personal property if necessary, if the deal goes south. And additional collateral. So additional collateral can be any other assets that basically deemed appropriate by the SBA or the bank. And then, of course, with SBA, we have full personal guarantee from Brandon. Brandon personally promises to repay the loan, meaning that if the business can't pay, he will be responsible for the debt. Now, personal guarantee can be negotiated, especially during crisis. There is an opening to negotiate with a bank. Obviously, we never want to get there, but it's definitely an option. And that's the downside of working with SBA. SBA is just one way to finance deals, and it's only for US citizens or residents if you have good credit. There are a lot of other ways to finance acquisitions, but SBA is just so comfortable to finance. And that's why a lot of people are almost automatically going into that route. Next, let's move into conditions. So conditions, we have prepayment penalties. So penalties for paying off the loan early within first 3 years. And that basically means that if Brandon pays off the loan early, he will actually face penalties to compensate the bank for lost interest income. It's a pretty good business to be in as a bank, right? So the penalty also decreases over the first 3 years. 5% in the first year, 3% in the second year, and 1% in the third year. And by the way, I'm looking at the side at the actual agreement, so I can expand on the notes. But this is what you see is pretty much kind of like a summary. We also have other fees and costs. So the borrower covers all expenses associated with the loan process, explanation. It includes fees for things like business valuation, appraisals, legal reviews, and other necessary documentation. And those are costs that can be significant, actually, and are often paid by the borrower or included in the loan amount. So it's pretty cool for a bank and the government. You give money, but then you take tons of fees in the process. Plus, you have all the collateral possible. So yeah, if you're in the business of giving loans, not too bad of a business if you have collaterals. That's why I have a few friends who have basically debt funds. but it's yeah, it's easier said than done to find those deals um, like it might look like. SBA just going crazy. People just go for it. But yeah, I guess also it depends on the asset class. Anyway, assignment of life insurance. So Brandon will need to assign life insurance to the bank. It means that if something happens to Brandon, the life insurance payout will go to the bank to help cover the plan, the loan, I mean. So yeah, they're making sure that they're getting paid. And then there's other loan requirements, so additional documentation and approval. That's basically that can include tax clearance certificates, licensing verification, annual financial reporting, and it's basically to ensure that all legal and regulatory requirements are met. So yeah, the term sheet, in a nutshell, outlines kind of like the financial framework for the loan for the acquisition. And obviously, it's there to help Brandon understand the loan structure and his financial commitments for giving him the money to buy the business. And it set the stage for the next steps, which involved thorough due diligence and final loan approval by the bank. So yeah, these details from the Byline Bank pre-approval term sheet, it gives Brandon clear picture of the financial aspects of his business acquisition. It's important to understand that each component to ensure that all financial obligations and conditions are met for the bank. And it's a document that you'll see all the time, and it's super crucial because it provides the roadmap for securing the funding to complete the purchase. Now, you might ask me, what do I think about those terms and whatnot? I mean, it's pretty common practice to have those things. Can you negotiate back some of it? The answer is yes, and that's why I recommended Brandon go and talk to other banks and see what kind of offers you can get. Interest rate is quite high, but it's depends on when you've seen this video. Based on the current market condition, it's fairly fair. I mean, it's, I don't want to say fair, but it's that's kind of like the what do we see in the market right now. Yeah, I mean, a few years ago, life was easier, but it doesn't mean that you can't do deals. It just means that you need to be more aware of your deal financials and just make sure that your debt, this DSCR, the debt service coverage ratio, is on point. And then you should be good to go still, even in the current condition of the market, assuming that your business is good enough. Next, let's move into the preliminary diligence memo. All right, so this memo that I'm going to go through, and again, this is quite a bit of a summary of the actual full memo, but this is me kind of like summarizing everything to go through it and see if there's anything crazy. But it's basically a summary of the preliminary legal due diligence that conducted by Brandon's legal team on this specific company. So we're going to go through that and explain each of those notes. So starting with, let's go back to let's try a red, blue pen now. So starting with the fact that it's a multi-state operations. The company operates in 19 states. It means, the only thing I see here is that it means that the company has a broad operational footprint, which can imply maybe a need for compliance in different states and regulations and employment laws for sure. That's kind of like the first thing that I'm thinking about. All right, next, let's focus on business registrations. So what do we see here? Registered in MD, okay, different places. We have registration issues. Recently formed a separate legal entity. Okay, no record of registration in Illinois. Georgia registration is MD at the end, which needs verification. So obviously, look, in the end of the day, proper registration in each state is definitely crucial if you want to avoid legal penalties and to make sure that there's smooth operations, right? It's kind of like the basic of business. Like, I remember a story with ChatGPT. They said you don't want to invent things as far as legality and structures. I remember when they kicked out Sam Altman, like because they're like a non-profit or whatever, and they had issues there with board governance and whatnot. So yeah, those are kind of like the basics of business. You want to make sure that it's dialed. So I will definitely have a bit of a discussion here with the lawyer to figure out what's specifically going on here and make sure it's nothing crazy. All right. Next, we have preliminary, the corporate and regulatory stuff. So we have corporate documentation. Yeah, generally straightforward, but charter requires at least two directors. Former shareholder transaction lacks proper documentation. Okay, so yeah, we want to ensure that there's corporate documents in order. It's just essential for governance, like I just said, and just overall legal compliance. So anything that is a bit of a red flag, I would just have a longer conversation with the legal team to understand the details, right? Because like proper documentation can be also just lacking or missing few signatures in some onboarding process as an employee. So I just want to figure out what they mean specifically. Permits and licenses. Only a few corporate registrations provided. Need to verify other permits. Okay, so yeah, obviously having all necessary permits and licenses will ensure that the company can legally operate and make sure that it can fulfill different contracts. Right, so this is also good to have. Customer contracts. This is important. Here we want to put definitely a lot of focus. So active contracts with key government agencies with 3 and 4 letters, that's always good, right? And obviously understanding those contracts, that's essential. If you want to evaluate the company revenue sources, obligations, and also just the understanding what revenue is guaranteed moving forward, super, super important. Set aside designations. Some contracts are set aside for specific business types, like a small business. Okay, so yeah, these designations obviously affect the company kind of like eligibility for different contracts and can impact any of their revenue if those designations change post acquisitions. So again, those things that I'm sure a lot of those things Brandon already had a chat with the owner about, and he understands at this point better than me about the business, of course, because this is the first time I'm looking at it. But those are just things that I want to understand what's the situation there based on the sector and whatnot. And then we have contract specifics. Okay, so those specifics are just, they help us understand a bit more about the terms, the potential risk and whatnot with each contract, what risk is associated with each contract. Okay, then you'll probably want to go through joint ventures and different team agreements. Those agreements, obviously, they're vital to understand. The company partnership, the obligation, different joint venture, commonly split 40 to 60% for partners, right? So obviously I want to understand who is in charge of an agreement like that or in managing joint venture like that. What's the contract there? Non-compete and non-solicitation clause. Okay. So this clause basically can limit the company ability to hire certain personnel or engage in specific business activities. So obviously something to think about as well. It can also be the other way around, right? If we're signing non-compete with some of our team members, they can go out there. So we want to make sure we have those agreements with our clients, with our employees, assuming that we don't want them going to competitors, right? Third-party agreements and vendor contracts. Okay, so significant vendor contracts. All right, termination clauses, freely terminatable or have specific notice requirements. I will want to understand what notice requirements we have. Is it like how many days? What's going on there? Because we want to understand the continuity and potential changes post-acquisition. That's the goal of due diligence at the end of the day. It's there to help us understand what are the potential changes that are going to happen post-acquisition and our potential risks or red flags. Outsource services, a lot of companies have those, right? But in most companies, I think 90% of companies that I look at have at least some kind of outsourced service at this point. It can be as simple as like web designer that is kind of like outsourced. So many times they're also crucial for the business. So I want to understand what the relationship with different outsourcing services, employment and benefit plans. So hopefully that's helpful. Let me know in the comments below if I'm going through all that, just to go into a bit of a checklist of what's in due diligence. So yeah, approximately 237 employee, mix of full time. It's fairly decent business, right? Obviously, you want to know how many employees. It will help us understand different kind of like labor costs, regulatory compliance, and understanding who's important and key to the business is also very, very important. We want to make sure there's benefit plans and they're managed properly, because obviously we want to make sure that employees are happy and satisfied, and we want to make sure that everything is compliant with labor laws. Consulting agreement, those agreements, we need to review them to ensure that there's no risk or liabilities with them or with any consultant. Financial indebtedness, include balance sheet. Yeah, okay, so we're going to go through a bit of the financial stuff with the legal. All right. So yeah, we want to make sure we understand the financial health of the company, right? Obviously, that we evaluate the value and the potential liability, long-term debts and no long-term debts. Lack of long-term debt is always, or at least can very much be a positive sign of like good financial stability. And the fact that you're taking another loan like the SBA loan, obviously we're going to put some stress on the business. So we got registration for the company name, the company logo, custom applications developed for specific contracts, real property. And obviously with IP, by the way, we want to make sure all IP is assigned for the company. Just write it down. Yeah, just to make sure we prevent future disputes and whatnot. List office space. All right, required for change of control, ensuring lease terms. We want to make sure they're favorable. We want to make sure we have understanding of the restrictions. We want to understand the contract in general. Like we don't want to come into like an office space and then find out the landlord like wanting to raise our fees. Insurance coverage details. Insurance is essential, obviously, for risk management and regulatory compliance as well. Pending legal various EEOC complaints. Okay. Yeah, I want to understand ongoing legal issues to understand the potential liability. So yeah, this memo in a nutshell is all about like understanding potential legal risks and understanding areas that need further investigation. Because we want to make sure that Brandon is fully aware of any potential legal hurdles before finalizing the deal. Each section that we went through provide, in the end of the day, a detailed look. This is just a bit of a summary and highlights at the different aspects of company operations, contracts, compliance, and just, again, all those due diligence steps just help us make an informed decision that we know what we're getting ourselves into. No business is going to be perfect, like nothing. Especially small businesses, in the end of the day, they're all in a bit of a mess. We can't expect them to be perfect, but we want to make sure that we make informed decision and we know what are the risks. Let's go through quality of earnings. Quality of earnings. Cool. So this document, again, we have like a massive Excel sheet that provides like detailed financial data to understand the quality of earnings of the company. So yeah. So what we have here. So in the other day, just so you know, my first thinking when I look at financials, understand, okay, do we have any recurring revenue versus non-recurring income? That's kind of like the first thing we want to look into to understand the quality of revenues. Because we want to see how healthy the company is, how stable it is. The more recurring revenue we have, it's more consistent, it's more predictable income. Non-recurring stuff, those are like one-time gains, losses. Like we want to understand what the future earnings will be when we'll be the owner. adjusted P&L and adjusted reported P&L. Okay, cool. So this is basically, compares adjusted profit and loss, reported figures. The goal here is to help understand the core financial performance by removing any anomalies or kind of like one-time events. That's the adjusted P&L. When you hear about adjusted EBITDA, the goal there is to remove any one-time event. So let's say, I don't know, a lot of business owner write off, I don't know, tons of food, for example. I have seen like literally a few people, business of owners writing off like 50, 100,000 a year on food. So maybe you see that and you're saying, you know what, I'm not going to spend 50 or $100,000 a year on food. My wife's cooking, I'll bring some food from home. So that $100,000 next year can potentially be my profit. So that's something that I can adjust when I recreate the adjusted P&L, the profit and loss. So anything, non-recurring is something you can look into. Because we really do that to understand like the core performance of the business. That's the goal. We don't want to see, I don't know, like a random Ferrari purchase that was written off on the business. We're not going to buy a Ferrari hopefully every year unless we want to. But when we buy a business, we want to know if that profit is something that, or if that expense is something that is going to be a recurring expense. Summary financials. Okay, so we want to just do a quick overview of financial health with this P&L. It's all about tracking the company's profitability over time. That's the goal, and to understand different line items. By the way, I have a great video. If you search Moran, Pober financial literacy, massive, like 3 hours video if you want to understand financials better. Balance sheet summary, BS balance sheet summary. That's all about providing a snapshot of the company financial position. Management, EBITDA adjustment. Okay, so this is all, everything when you see adjustment, it's all about to report where earnings were modified for clarity. Like we can, to give you an idea on different adjustments, it can be compensation removal. So adjustment, let's say if you remove specific employee compensation, if he's not working in the business anymore, or maybe the owner again took a massive salary and you're not going to take as much. Sometimes there's life insurance costs that could be removed. Can be also sometimes payroll taxes and different costs like that. So any normalization of payroll taxes can be part of it. Can also be adjustment for charitable contributions, rent that is maybe different. It's what's going to be bonuses, relocation cost, any kind of like a one-time thing that can be pretty dramatic, or like anything above like 10, 20, $50,000. If it's going to potentially come to your pocket next year, like you want to know of this potential. Taxation, detailed financials. We went through that. I mean, look here, just a few notes. It's all about like presenting financial data in a more understandable way. And I'll show you later the numbers, but this is like a bit of a summary. It's here all about examination of financial performance and to understand every aspect of the income, of expenses, of assets and liabilities in the business. GCR. We want to go through aging, receivables, and understand account payable, understand the quality of those, and see what. So one of the best things you can do to improve cash flow is to work on the terms with accounts receivables and payables. So if you can get paid earlier from clients and change terms so you pay later for your suppliers, that alone could massively change your cash flow in the business. So quality of earnings in a nutshell, it's all about providing comprehensive financial picture of the company. And again, to just help Brandon make an informed decision about the financial viability of the acquisition. And each part, like it's a massive, like the quality of earnings, like a few like a massive Excel sheet, and each tab, each section is going to go into different aspects of the company financial health to ensure that all elements are transparent and just well understood. All right, and then we're going to, obviously you'll want to do a deep dive. And now we're going to come into the interesting part. So here I'll share some numbers. But yeah, revenue. So here are some of the things we want to look into, right? We want to look into the trend. So for example, consistent revenue growth shows that the company is expanding and capturing more market share is obviously always good to see. Different profit margins. So healthy margins shows us that the company is managing the costs well and generating good profits. If we see good gross margin, operating margin, net margin, right, all those. And of course, EBITDA, which is a nicer way of saying pre-tax profit. High EBITDA in the end of the day shows us that like there's strong earning potential and just overall financial health. Obviously, there's cash flow analysis in the due diligence as well. So cash flow, obviously positive cash flow shows that the company can cover overall ongoing operating expenses and invest in growth. Free cash flow, that's the cash available after all capital expenditures. So it indicates that the company have some ability to generate cash and provide returns to shareholders. Like the best companies are companies that can generate a lot of cash without constantly raising capital. Trends, I want to see the growth trends or revenue, the rate at which the company growth is increasing. High growth rate are a good sign of market demand, business expansion. Also, if you're going to sell the business at some point, the higher your growth rate, the higher multiples you could get. And also just in general, the bigger you are, the bigger multiples you could get. Profit growth, again, same here, sustained profit just shows that the company is effectively turning and converting revenue into profit, into the bottom line. So overall, what is quality of earnings? It just gives us a detailed picture of the company financial health. We can see how the company is growing the revenue, how it's managing the costs, how it's generating profits. And it's important to understand these financial metrics to evaluate to see if it's a good investment or not. And now we're going to look at the actual numbers. So a few notes. When you're going to see FY, it stands for fiscal year. LTM stands for last 12 months. You're just going to see it in a bit. So let's look at this. So what do we see here? And I have thoughts. All right. So the revenue shows consistent amount of 26 million in 21. Slight decrease in the last 12 months to about 25, right? And the year-to-date figures for 23, 24 show an increase. So overall indicating growth in revenue, which is always a bit of a positive sign. But what happened from 21 down? So from 23 to 24, there's a bit of we're going up a bit. But what happened before, I'll probably want to check that out. We have revenue adjustments. So yeah, I'm immediately thinking like the revenue remains the same after management adjustments, which shows me that there are no unusual or one-time adjustments that are too crazy made by management, which is, I guess, a good sign. It means that they're quite disciplined with their expenses. They're not going crazy, probably not taking too much of crazy expenses home. Like weird expenses, I mean. Total revenue adjustment. So yeah, if you look at here, after due diligence adjustment, the revenue for LTM last 12 month 24 decreases significantly actually to like 18.3 million. Oh, okay. So that's because, so we have a massive adjustment here of 7.5 million. So it shows that there might have been some non-recurring or some kind of exceptional item that were adjusted, right, to reflect the core operational revenue. So it's definitely something to pay attention to and understand what happened there. Then when we look at net income, Um, Net income decreased, right, from 21 to 23, but the year-to-date figures show improvement from 1.8 in year-to-date 23 to 1.7 in 24, and we're just in the middle of it. So there is a positive trend in profitability. That's good. I want to understand what happened there. Net margins. If you look at here, the net margin decreased from 8.28 in FY21 to 6.02, but it improved in 24, which is a good sign of profitability efficiency. That's always good. It shows definitely a good sign and good management if we see net margin improvement. That's always good. EBITDA decreased from 21 to 23, but similar to the net income, if you remember, it shows improvement in year to date. So it shows also better operational performance. So this last year is very interesting. I would be curious to understand why he's selling the business. And then reported EBITDA. So the EBITDA margin is decreased from 8.84 to 6.88 in 23, and then improvement to 8.33 in 24. So yeah, again, reflecting better kind of cost management and profitability. Great sign. So management is doing something right. So just my 2 cents conclusion. The company shows like consistent revenue. You see some fluctuation because of the adjustments, which can make sense. Net income and EBITDA shown positive trend in the most recent year-to-date figures. This is really good. It shows that there's improved in profitability, improved in operational efficiency. And these financial metrics suggest that the company, I think, is recovering well and can be, I think, super healthy acquisition, especially if we recall there are government contracts, which are usually very stable. So I will want to understand the contracts. I will want to understand who are the key people. So we have more than 200 people. I will want to make sure that they are still staying with us. I want to understand what's the role of the owner as part of bringing revenues and overall day-to-day to see if it's replaceable. And if not, what is going to be the transition period with him? What kind of training from him? The adjustments made during due diligence are pretty significant. So it's showing you the importance of scrutinizing non-recurring items to get a clear picture of the company real financial health. So yeah, hopefully this is helpful. Let me know below if it is. And yeah, leave a comment below. Take care. I'll see you soon. Have a good one.